My dear students, this is ARD, your accounting coach, and the topic of the day is account and its types. Now, what does account means? Account is a collection of transactions. I can give you an example of a classroom. If there is a place, then many students are gathered at one place. This place is maybe known as a classroom or a cafe maybe. So a place where the students are gathered is known as a classroom, and a place where similar transactions are combined or grouped is known as account. So account is a place where similar transactions are collected. The most common type of account is a T account. Now why does a T account is known as a T account? Because it is made in a shape of a T. So there are two sides in a T. The left hand side is known as debit side and the right hand side is known as credit side. Now I am making a sample account for you. See, as you can see, this is in the form of a T. So this is known as a T account, and the top of that we write title. The title is the name of the account. Maybe for a customer account is for a debtor, that is customer. It can be for a creditor, it can be a cash account or a bank account or some other asset account or liability account. Now I have made an example or a sample account for Mr. X, and I have assumed that Mr. X is my customer or my debtor. A debtor who is a person or a company whom we have sold goods on credit, and now we are expecting to receive money back from him. Now left hand side is debit side and right hand side is the credit side. Now as you are aware, if you have listened to my double entry lecture, and if you haven't, I may strongly suggest you to listen to the double entry concepts lecture before going forward. So left hand side is debit, right hand side is credit. Debit and credit does not mean plus or minus. Debit is the left hand side of a T account and credit is the right hand side of a T account, and debit and credit are special terms used in double entry. Double entry is a system on which the entire building of accounting rests. So we'll be starting with opening balance on first, that is 1000, means on first of the month we are asking money from our debtor Mr. X 1000. Now why are we asking money? Maybe in the previous month we have sold goods to Mr. X and he still owes us the money 1000 at the start of the year. Now on 5th we sold him some other goods that is worth 500. So we'll be debiting Mr. X account and we'll be crediting sales account. Now why we are debiting or crediting this? We need to make sure to study the previous topic, that is double entry system. Then if we have a customer have returned goods worth 100 due to some reason, why? Maybe the goods are of wrong size or quality, or the customer has not ordered it and we have sent to him by mistake, or maybe he does not no longer needs the goods and he have returned goods back to us and we have accepted it back. This is known as return inward. So whenever we sold goods to our customer, we will be debiting his account or her account, and if the customer is returning that goods, we will be crediting his account. Then on 8th, maybe the customer has paid us the amount owing, that is 1000. We'll be debiting bank and we'll be crediting customer account. Then we need to balance this account. All of the T accounts are balanced at the end of the month or at the end of the period. So how will be balancing this? The bigger side or the greater side is debit side. This left hand side is debit. DR stands for debit record and CR stands for credit record. The greater side, this is the 1500 and this is 1100. So we'll be writing 1500, that is greater side, and the 1500, the greater balance, will be written on the both sides. Now the debit side was already 1500, but the credit side is not 1500, it is only 1100. So what we need to do, we need to make this side also 1500. How? So we need to struck a difference between the two. If we deduct 1500 and 1100, the difference is 400. So the difference on the shorter side, always known as balance CD. Balance CD is closing balance, and as you are aware, the balance CD becomes balance BD in the next period. So balance carried down on 31st will become balance brought down on 1st January maybe. If this is December, the second month, next month will be 1st January, balance bidding. Now this was a T account. Let me explain it to you once again. On the start of the year, our customer Mr. X owes us 1000. Then in this month we have sold goods to him worth 500. Now we ask him 1500. Now he owes us 1500. Now out of that 1500 he have returned 100 goods back to us. Then he have also paid us 1000. If we deduct 1100 from this 1500, the balance remains 400 at the end of the month. This means at the end of the month and the start of the next month, he still owes us 400. This is known as a T account. Now, instead of making a T account, we can also make a 3-column account, also known as running balance account. Now, what is the running balance account or 3-column account? It is an alternate form of a T account in which there are 3 columns. Now in a T account there are 2 columns, one is debit and one is credit. In 3-column account there are basically 3 columns, one for debit, one for credit, and the third one is of balance. Now what is the advantage of this 3-column account? First of all, we need to make this 3-column account and then we can understand what is the advantage of this 3-column account. Now with the same data that we have discussed in this Mr. X, we need to make a 3-column account starting with date, then particulars, then debit, credit, and then balance. So this is the format for 3-column account. We will be starting with opening balance. As you can see in Mr. X account, the opening balance, that is balance BD, is 1000. So we will be writing 1000 in the last column, that is debit. This is a debit balance because asset balance is always stated as a debit. Then after first, the next transaction is on 5th. We have sold goods on credit. Whenever we are selling goods to our customer, the customer is always debited because asset always increases on debit. Now see, there was a 1000 debit balance and we have sold goods worth 500 to him. So debit and debit are both added up and there comes the balance of 1500, which is again debit, because if both of the balances are debit, the total is also debit. This means at 5th date, at 5th December, now our customer owes us 1500. Now after 5th there was a transaction on 7th, that is customer has returned goods to us, which is also known as sale return or return inward. If the customer has returned goods to us, we will be deducting his account, that is we are crediting his account. Now out of the 1500 balance, the customer has returned goods worth 100, the balance remains at 1400. Now after 1400, the next transaction is bank 1000, means customer has paid us 1000. If the customer has paid us the amount, we will be crediting his account. Out of 1400 debit, 1000 will be credited and their balance remain as 400. Now 400 remaining balance will be a debit or a credit, depends which is the bigger number. See, 1400 is debit and 1000 is credit. Means debit figure is greater, the sign of debit will come, and these are the transactions. Now, what was the advantage of this 3-column account? Advantage is that we get an up-to-date balance after each transaction. This means if on 1st December the customer Mr. X calls us and asks for his balance, we will be telling him that his balance is 1000. Then on 5th, if he calls and inquires about his balance, we can easily state his balance 1500. Then on 7th, if he asks for his balance, we can tell him the balance, that is 1400. So now after every transaction we can get an up-to-date balance. Now one problem with 3-column account is that it has a lot of calculations. This is a calculation intensive method, therefore it is only suitable for computerized accounts. As you are aware, if you have seen a bank statement always comes in 3-column format, that is debit, credit, and balance, or maybe deposit, withdrawal, or balance. This means the same thing. So banks are not making 3-column or statements manually, they are using computers for it. So 3-column accounts are most suitable for computerized transaction. Now let's move further. There are types of account. There are 2 types of basically account. One is personal accounts and one is impersonal accounts. Personal accounts are one that belongs to some person or individual or company. Personal account, there are 2 categories for personal account, one for debtors and one for creditors. Debtors are also known as trade receivables and creditors are also known as trade payables. So debtors are the persons, individuals or companies whom we have sold goods on credit and we are now expecting the money back from them, and creditors are the persons or businesses or companies whom we have bought goods on credit and now they are expecting money back from us, and this means they are creditor for us. Say these two categories come in personal accounts, and after all these personal accounts, all of the accounts that remain come in impersonal category. And impersonal category is further subdivided into two parts, that is nominal account and real accounts. Nominal accounts are also known as temporary accounts, and nominal accounts are all of the accounts that are coming in income statement. If you have prepared the income statement previously, there are some items, that is sales, purchases, return inward also known as sale return, return outward also known as purchase return, income and expenses. Now all of the items that are coming in income statement are known as nominal accounts. So nominal accounts are temporary accounts. Why? Because every year these accounts are made again. Why we are making these accounts again and again? Because every year we transfer the balances of these accounts to profit and loss, that is income statement. And the real accounts are also known as permanent accounts. Real accounts contain all items of balance sheets, that is statement of financial positions. All of these items are permanent, that is assets, maybe inventory or non-current assets, and liability and capital. All of the items that is coming in balance sheet and statement of financial position, this is the same thing. These are real accounts. So real accounts are accounts that are used for more than 1 year, and nominal accounts that are accounts used for less than a year. So I hope you understood the concepts behind an account and what are its types. And if you like the video, kindly do share this with other fellow students. And if you haven't subscribed my channel yet, kindly do it now. Thank you.